Hi, my name is Raymond Rofe. I am the CEO and co-founder of Pave.dev. At Pave, we're delivering AI-powered cash flow and affordability scores to answer the question of the borrower's ability to pay. Through our customers, we've serviced over 4 million Americans, we've reduced defaults by 26%, and we've increased approvals by 17. So why now? Lending is harder than ever in the last decade due to high interest rates and the lack of qualified borrowers. Credit scores don't tell lenders the whole picture about a borrower's ability to pay. And 3, consumers are permissioning more data than ever, but there's no real infrastructure into all of this new data. And it's paving the way, pun intended, for new scores to understand one's ability to pay. At Pave, we've developed an analytics platform so credit risk teams can do 3 things. 1, increase volume by finding more healthy borrowers, personalize affordable monthly payments, and 3, detect early signs of delinquency. Our scores and attributes feed into loan origination systems, credit and fraud decisioning systems, and their own proprietary models. What I'm going to show you today here is 2 things. We'll briefly walk through how Pave works and how it's integrated into your pre-qualification flow. And 2, lastly, we'll show you what credit teams get to see with our scores and analytics platform. So here we have, what I'm going to show you here is a standard pre-qualification flow for an auto loan, right? But before diving into the flow itself, let me tell you a little bit about the applicant, Susan Smith. So Susan is in her late 40s, recently divorced. She's a nurse. She needs a car, but because of her FICO score, she's either getting rejected or the loans she's getting that she's getting offered aren't really appetizing. And her divorce is relevant to mention here because married couples typically are built on one spouse's credit. And so when they get divorced, when one gets divorced, they're left with a thin file oftentimes, okay? So let me just kind of go through the application flow of what you see here. This is nothing new that you guys haven't seen before. So, Susan's going to fill out her information here, address, everything else. She's going to share her bank data as part of this flow as well. And so, we've used Plaid here to connect. So she's going to connect her Plaid data. And so we've got all the Plaid data here, at least Solstice Savings Bank does. And so this is where the magic begins with Pave here. So what's happening in the background, you're seeing that multiple data sources that Susan is permissioning to the lender is being sent to Pave. This includes open banking data from bank aggregators. This includes Equifax. This includes Experian, data from Argyle, data from Method Liabilities. And what Pave is doing in the background here is merging and unifying this data into one profile to understand the cash flow and affordability of Susan. Now, we've created over 100 models here, anywhere from detecting and predicting income to detecting mortgage and rent, and even non-bureau loans like BNPL or even title loans. All of this to power our affordability and attributes. Our scores and attributes. And keep in mind, our scores and attributes are inputs into proprietary models. Loan origination systems are using us, credit decisioning systems are using us as well. And so what you see here is the proprietary model will be calling our attributes model, using all these values here and inputting into their own model. And so this allows Susan to get pre-approved, leveraging all of this data. And again, we're seeing that she's a healthy borrower. She's given some choices here. So that kind of concludes the first stage of how it works within the API model of this. Now let's kind of shift towards what credit teams get to see. I'm not sure if this is big enough. I think it is. So what we're showing here is kind of all the factors that goes into Susan's affordability score, right? We center this view around 3 numbers. Now you can see here, here's the affordability score. This is 742. This was captured in the API earlier. We mentioned that her credit score is 683. And then the golden number there is $3,500 in terms of understanding her own affordability. So what are we seeing here exactly? What we're seeing here is a FICO score. We give some level of explainability in terms of why she's a 683 FICO score. She has a limited credit history. She's utilized a lot of her credit, but because she has so little credit to begin with, she has to utilize a lot of this. And so this puts her into this near prime bucket, essentially. And so with the cash flow data that we have access to through open banking, liabilities data, and everything else, well, we understand a lot of things about Susan here. We understand that, okay, she's very highly predictable in terms of her income. She has very low obligatory payments. And she always, she manages her balance really well. She has almost actually zero overdraft and NSF fees, right? And coming back to the $3,500 here, what we're seeing is essentially today we see that she has $3,500, but because of future liabilities she's going to be paying off, we're seeing this is actually going up to $4,000. And in fact, in a couple months, it goes up to $4,200. Again, showing off the fact that, okay, this is a very credit-worthy person who's going to be able to be able to pay off her loans. So this is just a view just on Susan itself. Now the question comes back, if I'm a credit risk team, well, I want to see more, more folks like Susan. How do I do that? Well, what we have here, let this load. What we have here is a dashboard of all the applicants that we have in the last few days. We have 31,000 applicants. And we basically show a distribution of basically what this looks like from deep prime to all the way to super prime. And now I want to see, again, more folks like Susan. What we're seeing here is the segmentation piece of what Pave is really good at. We have thin-filed, healthy cash flow customers, recovering shock, healthy customers. And this is the bread and butter of what we do. Segmentation is a great way to humanize and rationalize how and who we're giving loans to. And at Pave, this is a big piece of why so many lenders like working with us, because they know exactly the types of segments that they're giving loans to. That concludes my presentation. If you guys are interested, feel free to stop by our booth. Thank you very much.